Welcome to GRE. I'm your host, Keith Weinhold. In today's environment of 15 to 20% home price appreciation, what does the mortgage lending landscape look like for investment property, including a new lending alternative that could very well be the easiest loan that you're ever going to get? Today on Get Rich Education. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to fourplexes. They're the number one lender for beginners and veterans. Start your pre-qualification, chat with President Caeli Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com. Checkbook IRAs have been ruled illegal by the U.S. tax court. With contribution limits 10 times what traditional and Roth IRAs allow, get total control of all of your IRA funds without paying the nasty UBIT tax with the retirement plan answer left standing, the EQRP. You can invest your retirement funds in real estate, gold, Bitcoin, and even your own business. This works whether you're a solopreneur or have up to 50 employees. Learn more about getting started. Text EQRP in all caps to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE from St. Augustine, Florida to Sault Ste. Marie, Michigan, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. I trust that this week you are doing the right thing before you do things right. You're listening to episode 386. Yeah, 386 of them. And among all of those episodes, I think that 2 of them have actually been pretty good. Well, so far this year, gold and oil have been up, stocks and crypto have sunk into correction territory, but now let's be mindful that real estate, it's actually experienced quite a divide in the last couple of years because office and retail and a lot of the commercial sectors have been hurt pretty hard. We have long championed residential real estate here from day one, which has obviously thrived. And another real estate sector that has thrived is warehousing. Vacancies in warehouses are effectively zero right now. And much like residential rents are spiking some 19 or 20% year over year, understand that warehouse rents are spiking some 18% in the United States right now. And why is that? Well, think Amazon and how the pandemic shifted dependency over onto those e-commerce services that need those warehouses, and how that 1 square foot or 2 square feet of warehouse space has replaced a lot of the square footage evaporation in retail. Now, back to residential, one emerging trend is just how much the real estate investor, including the individual one like you, have effectively now, you're pushing out first-time homebuyers. Record high home prices and low inventory, they were already making things pretty hard for first-time homebuyers, but there are some new numbers that show that investors are driving even more people away from getting into their first home. In fact, Lawrence Yun, the chief economist for the National Association of Realtors, he recently said that investors are coming in and pushing out first-time buyers. 1 year ago, the percentage of home sales that went to investors was 15%. And today, here a year later, it is up to 22%. And meanwhile, sales to first-time homebuyers, that was 33% a year ago. And now that share of home sales to first-time buyers is down to 27% at the start of this year. And under more normal conditions, first-time homebuyers, they would make up about 40% of sales. That's what you usually see over time. So that has really been squeezed down. Now, this trend of, it's not necessarily wealthy, but it is somewhat affluent, somewhat better off, that class of people and investors, with them displacing first-time homebuyers, really that makes a lot of sense because now that prices have become higher, those wannabe home buyers, those were the people that were on the cusp of getting pushed out anyway. They were often barely qualifying anyway. And to put the last piece in that puzzle, when those wannabe home buyers that were teetering on the precipice, when they get pushed out, what that does then, when that prevents them from buying, is that obviously keeps them in that renter pool, driving rental demand, spiking rents 20% nationally now. And therefore, what it does is it makes better investments for those investors that could qualify for those investment properties today. So yes, often it has been the investor beating out the first-time homebuyer for this low housing supply where here in America, we are still short some 3 million to 4 million housing units. Now, when it comes to that all-important financing component for residential real estate and those mortgage interest rates, a lot of people get confused about this, and you might have been at one time as well. Last week here on the show, I reminded you that the last 6 times that mortgage rates increased, home prices increased every single time. Well, if higher mortgage rates correlate with higher house prices, then do lower mortgage rates correlate with lower house prices? The answer is no, not really. In fact, mortgage rates have generally fallen for over 40 years now, and on a nominal basis, house prices have risen, except for really this one period of time when exceptional things were happening from about 2007 to 2011. That's when housing supply was high and mortgage underwriting standards were just laughably bad, like frighteningly poor. Well, do you know what the mortgage rate trend was during that time from about 2007 to 2011 when house prices fell? Do you think the mortgage rates rose then and that's part of why prices fell because you had to pay more for interest rates during that time? Do you think that that's part of what happened? No. In fact, as house prices fell during that global financial crisis period of time, that is when mortgage rates fell as well. So maybe you would think that falling mortgage rates would make home prices shoot up because more people could afford them. But no, 15 years ago, lower house prices correlated with lower mortgage rates. So what is the commonality here? I think that the most important takeaway for you as a long-term real estate investor could very well be that mortgage rate direction, it really does not affect house prices all that much, and certainly not as much as what a layperson thinks. It's the condition of the economy. That's what has more to do with house prices than mortgage interest rates. So if you want to know the future direction of house prices, well, then it makes more sense to look at things like the unemployment rate and the growth in GDP and the supply of housing. And if you're going to look at mortgages, then even look at mortgage underwriting standards as much or more as those mortgage interest rates. Yeah, I can make the case that every one of those things has more to do with the future direction of house prices than mortgage interest rates do. So that's really the big takeaway here. It's the condition of the economy more so than the mortgage rates. Because when the condition of the economy is good, and when people are employed, and when people feel stable in their job, well, then what do? They look to go buy a home. It has more to do with the security of that borrower and their situation and their confidence in their job and their income stream than what mortgage rates are. Now, we're about to talk to one of America's foremost experts on mortgages for investment real estate today. She is the longtime president and CEO of her own firm. She's been a familiar guest here over time. For some pretext today, understand that the mortgage rates that we quote here are for income property loans and not your primary residence. And oftentimes we record with our guests just shortly before we publish the episodes here. It's not like there's a delay of weeks or even months like some other shows might do. So you're going to get some really concurrent information here, but you're also going to get some good long tail material that does not change over time. So we're going to talk about those qualifications you need, things like your credit score and your debt to income ratio. And gosh, I'll tell you, especially earlier in my investor career, that debt to income ratio I had, sometimes it was too high. That's what prevented me from qualifying for property. So I really had to work with my mortgage loan professional to help get that down so I could buy more income property. We're going to talk about appraisals. In this high real estate appreciation environment, are those valuations, as far as the appraisals, are they keeping up like they need to? And also, near the end of our chat, I'm going to be sure that we discuss something exciting and new, and that is DSCRs, debt service coverage ratio loans. You may very well find it to be the easiest loan that you're ever going to get, where rather than qualifying for your mortgage loan primarily on you and your criteria and your credit score, rather than that, you qualify more so based on your subject property's performance and how much rent it generates. It's more about the performance of the property than you and your personal financial picture. And if you want to watch the video of today's chat, we don't have them all on YouTube, but you can indeed watch this one on our YouTube channel. We are pretty consistently branded. Our YouTube channel is named Get Rich Education. Really easy to remember. Let's meet with this week's guest. I'd like to welcome in the president and CEO of Ridge Lending Group. And importantly, she is a real estate investor herself. And Ridge has helped more families realize their dreams of homeownership as real estate investors than any other mortgage lender in the entire nation. Welcome back to GRE, Caeli, Ridge.
Hey, Get Rich listeners. Thank you for having me, Keith. I'm very happy to be here with you all today.
Ridge Lending Group, they specialize in income property loans. So you just don't tend to have those problems or wrinkles that you have with some of the other companies where they specialize in owner-occupied loans. In fact, Ridge Lending Group is where I got my last few income property loans and where I did my last few refinancings. I have physically been inside their main offices, and right on their website, they even have a core value of thinking and investing through an abundance perspective rather than through a scarcity perspective. So they're so aligned with what we do here. Interest rates are changing all the time, and so does the mortgage industry. But Caeli, I think with mortgage rates being a newsworthy item lately, it's interesting to talk about just where we're at with mortgage rates now to at least lend some historical perspective to this. And I think it's important to get that because in 1981, 30-year fixed mortgage rates topped out at over 18%. In the year 2000, they were about 8%. And in the year 2010, rates were about 5%. Now, I know since really January of this year, the 30-year fixed rate really started up its climb from about 3% to about 4%. Why don't you just talk to us today with where we're at for mortgage rates?
First, thank you for that lovely introduction. We do try very, very hard to live up to all of those things. Hi again, everybody. Interest rates is always one of the hottest topics that we talk about day in and day out with our clients. And you're right. People tend to have kind of short memories on occasion when we talk about the long-term mortgage rates. As an example, too, just to add to what you were saying, pre-pandemic, for those that are interested, we were in the 5.5% rate range for investment properties. We're still below that. So I'll go through a couple of examples. Those of you that have heard me talk about interest rates before, this might just be kind of a recap, a reminder. But I want to start by saying that like anything else, rates are not created equal. Okay, we have to very clearly define the characteristics of the transaction in order to get us the appropriate rate that would be attached to that loan. These variables are things like the occupancy of the property. We're talking about non-owner occupied, a very different rate than an owner occupied.
Right.
The loan size, the loan to value, the property type. Is it a single family residence? Is it a 2 to 4 unit? The credit score that you come with. All of these variables have their own unique price adjustment. I won't get into all of the weeds of that, but let me quantify for you what we're talking about today, and then I'll get you guys some rates, and then I want to put some other things into perspective for everybody. We're going to assume a single family residence. We're going to assume that this is a purchase transaction. We're also going to assume that the individual has a 760 or better credit score. And I'm going to look at this both from 75% loan to value and an 80% loan to value. And that's the perspective that I was talking about, just to give people that baseline, because I think that there's a psychology behind the actual number of the rate and not really doing the math. And then the light bulb goes off, et cetera. So again, $150,000 at 20% down, our loan amount will be $120,000. The rate you'd be locking in today would be 5.25%. 760 credit score, single family residence, purchase transaction. The principal and interest payment at 5.25% on $120,000 is $663 a month. Let's take that scenario at 25% down. Our new loan amount is $112,500. The difference there is $7,500 of capital expenditure, right? 5% of 150 is $7,500. 4.75 would be the interest rate at 25% down, yielding a principal and interest payment on $112,500 of $587. The payment difference, principal and interest only, we don't care about the taxes and insurance. Those are static. They're going to be what they're going to be.
Right.
But the principal and interest payment between these two is $76 a month. The math you guys want to do is you want to take $7,500 and simply divide it by that $76 a month payment difference. That math is going to tell you how many months it would take to recapture the upfront capital versus the savings. That ends up being about 8.22 years or 98 months. Keith, I think that I'm fairly confident to say that you'll agree that the leverage, when you do that math, the rate of return on that higher leverage is really where you want to be. First of all, you've retained $7,500 that you could use to deploy for another investment, and I'm certain probably make up at least $76 in cash flow somewhere. Or if you wanted to, you could simply keep your $7,500 and pay yourself $76 a month for 8 years. Leverage generally is going to be the winner. Interest rates as they are today still lower than we've seen them in some time, historical lows. I think it's important to also highlight that when rates go up, we always see rents follow. It doesn't happen at the same trajectory, but they will get there. So keep that in mind as well.
That's right. When rates go up, it reduces affordability for those most vulnerable first-time homebuyers, and that keeps them in the renter pool. But yeah, to your point, Caeli, generally, I am in favor of leverage over time. With the example you gave there, it's a difference between 4-to-1 leverage with 25% down and 5-to-1 leverage with 20% down. It is interesting, however, that there is a 1/2 of 1 point interest rate difference between 20% down and 25% down. That's more than I would have expected.
Yeah, 0.5 point. And that's today. Remember, secondary markets have a way of dictating, where that spread is going to be. There's a lot of variables that play into how the rates are going to fall for that particular day or even that time of the day. Inflation right now, we've talked on this before, Keith, is playing a role. I hate to speculate, but what's happening in the Eastern Bloc and some things, the news headlines of all of that, we may find a little bit of a reprieve. Generally, I feel like for mortgage-backed securities and the long-term bonds, if there is volatility in that uncertainty sector that might require U.S. troops, anything that happens there, we may see rates come down a little bit as a result of that. That's generally the rule of thumb is that when you have a lot of uncertainty on secondary markets related to things outside of everybody's control, we might see a little improvement in rates.
Yeah, it's strange. Uncertainty can actually be worse than bad news for these sorts of things. But yeah, Caeli, we talked about mortgage rates and spreads and so on. Why don't we talk about the spread between mortgage interest rates for an owner-occupied primary residence home buyer and a non-owner-occupied, an investor property loan? What is the spread between those two, and what is that dictated on?
So really, it's just the occupancy. I mean, if just as a general rule of thumb, you're typically going to find a 1% spread between just the occupancy. But remember, those other variables that are going to dictate or play a role have a huge impact. If we're talking about a 75% non-owner occupied cash out versus a 50% rate and term owner occupied transaction, it'll probably be a bigger spread than just 1%. Because the lower the risk, the better the rate. The higher the risk, the worse the rate, I guess is another way that you can kind of quantify it. So primary residence, less risk than a non-owner occupied, a rate and term, less risk than a cash out, a 50% LTV, less risk than a 75. So all of those things kind of have a balancing act attached to them.
We're talking about what's called that risk premium that a lender adds onto a property because an owner of that property is more likely to walk away if they don't live there themselves.
That's true. The philosophy, that's what the investor is kind of basing the price adjustment on. I may argue that point just because I remember what it was before the 08-09 debacle of housing and lending. Fogging a mirror was all you needed to do to get a loan. The sweeping legislation related to investors and mortgage lending, you have to walk on water now to get a loan. Right? So the criteria to qualify, you have to have very high credit scores. This is conventional lending, obviously, we're talking about. Very high credit scores, lots more skin in the game, assets, lots more assets. So all of these things now, I think, preclude some of that risk. And I feel like it should kind of be relooked at, but that's not a decision for me to make. Just my soapbox, I guess.
So even though mortgage interest rates have been up in the past few months, they are still historically low. So of course, borrowing 80% gives you more of that borrowing power than borrowing at merely 75%, as well as the leverage component. So Caeli, why don't you just go ahead and talk to us about what it does take now to qualify for a non-owner occupied property, a rental single-family home up to fourplex with respect to down payment and debt to income ratio and those sorts of standards?
There's three primary baselines for qualifying: credit, assets, debt to income ratio. Let me talk quickly about the difference in leverage opportunity between the property types. A single family residence on a purchase transaction, you can actually leverage as high as 85% loan to value, where you're putting 15% down. In this case, and that's for single family only, you will expect a higher interest rate, slightly higher interest rate. And of course, anything over 80% loan to value conventionally will have PMI attached to it. This is private mortgage insurance. I would calculate a factor of 0.52% if you're going to try and do this math for yourself. Simply take the loan amount. So easy math, if you had a purchase price of $100,000, 85% of that is $85,000 is your loan amount. Take that number times 0.52%. You're going to get a number. Divide that by 12 months, and that will be roughly what your PI payment will be on that particular transaction. That's for the single family. Some people don't love the idea of PMI. I think you should look at it with both aspects, see how the numbers play out. The math won't lie. Anyway, 2 to 4 unit, so 25% down on a duplex, triplex, fourplex. The qualifying criteria, those three pieces: credit, assets, and debt to income ratio. Credit, if you have 6 or less finance properties, you could have as low as a 650 credit score and probably get qualified if you had a low DTI, debt to income ratio, or strong assets. Those are compensating factors. Once the individual reaches a 7th finance property and up to 10, still within the conventional guideline space, they must maintain a minimum middle credit score of 720 or greater. There's hard and fast, no getting around that. Assets. So you need your 20 or 25% down, or 15% if you decide to go 85%. Your assets need to be sourced and seasoned. This just means that any large deposit that is in a bank statement that you supply us, a large deposit will be anything over 50% of the income that we're showing for you. I like to give examples. Let's say that you make $10,000 a month for easy math. If there's a deposit in a statement that you provide us of $5,000 or more, I'm going to question it and say, okay, Mrs. Smith, where did this $5,000 come from? If we can prove it started from you or originated from you, bonus or commission or whatever it might be, sale of stock, that's perfectly fine. If I can't source it originated from you, then I cannot use that as sourced and seasoned. So as the example I always give, if great Aunt Alice provided you or gave you $50,000 and said, here you go invest in real estate, then well, that would be great. I cannot see that deposit. So it would have to sit there for 2 months to where you supply me with 2 months of bank statements. The deposit is not listed, simply the balances are there, and that would be fine. Otherwise, you can't use it. That's sourced and seasoned. It can be liquid or non-liquid, can satisfy the reserve requirement. So your 401k, your whole life insurance policy, your self-directed IRA, and liquid, if you needed to use it and you're checking your savings account, perfectly fine. All of those can satisfy the requirement of the reserve. And then finally, debt to income ratio. I'm just going to focus on a W-2 wage earner for this because self-employed could get a little bit crazy and squirrely. You'll want to call us directly for those numbers and formulas. 50% is the max threshold to qualify. So if you made $120,000 a year, you have $10,000 a month of income, $5,000 a month maximum has to cover all of the monthly liabilities that we will find on your individual credit report.
Right. Okay. So for example, the minimum monthly payment on your credit card would go into that $5,000 sum of one's monthly debts.
Right. I don't care what the balances on those credit cards are. All I care is what shows as the minimum payment. And we really only care about the credit report minimum payments. So people think that their ordinary living expenses like food and gas and utilities and cell phone bills play a role. They do not. There are 3 exceptions that must be included in a DTI that won't be found on a credit report. They are if you're a renter, that primary housing expense has to go in there, HOA dues on a property, and any taxes and insurance that you pay separate from a mortgage that you had secured, right? If you're paying your taxes directly to the county or your insurance directly to the agent versus having it wrapped in your mortgage, those have to be in there too. Otherwise, it's a simple division of income versus monthly on the credit report. 50% is the threshold.
Okay, we've been talking about conventional loans at those best rates and terms, which sometimes we refer to as golden ticket loans because the terms are so favorable. And this is for your first 10 non-owner occupied income properties, single, or first 20 married. How much worse do the terms get when we go beyond 10 or 20, Caeli?
We're seeing the margin narrow a little bit between a conventional and a non-QM or a debt service coverage ratio loan, for example. Again, the characteristics are key, and those variables per the transaction, the loan to value and credit score and all of these things. Right now, I'm going to say roughly a percentage point. So if you're at 5% on a conventional for those variables and characteristics, you're going to be probably around 6% after the 10.
That's really good to know. Well, Caeli and I have more to discuss about cash out refis and whether or not appraisals are keeping up with this higher appreciation environment, and also an alternative way to qualify. You're listening to Get Rich Education. Our guest is Ridge Lending Group President, CEO, Caeli Ridge. More when we come back. I'm your host, Keith Weinhold. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com. You can get a 50-year-old house somewhere or buy a new one directly from the builder with tenant resilient amenities already built in. With over 3,000 Florida units at different construction stages, they are exclusively for investors. President Wagner and Alaska and team also invest strongly in their own product. That's belief. Start at buildtorentdirect.com. That's rentdirect.com, or text 407-927-5074.
This is Hal Elrod, author of The Miracle Morning, and listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. We're talking about financing, such an important part of investing. Oftentimes, 75 to 80% of your property cost is tied up in the financing and getting those terms just right. Caeli, now that we've seen this run up in appreciation of properties, we have higher interest rates, but then, of course, the flip side of that is there is more of this equity for an investor to go for and liquefy to do whatever they want with it. So talk to us more about the cash out refinance climate today.
I would say that industry-wide refinances are down for most people. However, for investors, I'm noticing we haven't really missed too much of a beat there. The more seasoned or savvy investor understands the mechanics of this, that even while they may be increasing an interest rate, borrowed funds are non-taxable, right? And utilizing that to acquire more investment properties with that extra cash flow, it's real important for the individual to just do the math. Figure out what is the increase in monthly payment versus what they're getting out of it and what they will take it and transition it into. The math does not lie. So just do the work, crunch the numbers, and figure out if it makes sense based on the variables I just described. More often than not, I think that investors find that the cash out, especially with the availability of that equity, is worth it rather than just leaving it there to do what?
Exactly. When one realizes that the return from home equity is always zero. And to your point, the IRS classifies a cash out refinance as a tax-free event. That often makes people want to go ahead and take advantage of that accumulated cash in their property.
And if I might interject too, remember, you have to do the numbers, and I may be splitting hairs a little bit here. You're able to deduct the mortgage interest that you're paying. So if you're paying interest on 3% versus 5%, there's a secondary incentive. It's not going to be massive, but if you're going to do the math, you might as well take it all the way to its conclusion and include that piece as well.
That's a really good point. Now, whether one's doing a cash out refinance or a new purchase of income property, of course, that lien holder is going to require an appraisal. How are we looking with appraisals today, Caeli? In this higher appreciation environment, are appraisals able to keep up? If they're not, are people willing to pay cash to make up that gap? How does that look?
I think that question is largely specific to the individual market and sometimes even the neighborhood, but I am finding less common that we're seeing short values. Appraisers aren't really going to There's some algorithm within what they're required to produce. But if the purchase price is $100,000, but the real market value might be 150, you're getting a steal. You'll rarely see an appraisal that actually gives you a $150,000 valuation. They're going to keep it closer to the actual purchase price for whatever their requirements or guidelines or regulations are. On a refinance, we're finding that they come in at the estimated value that we put in with the order. We're not really seeing too often, maybe we did a few years ago, shorter values where that would be an issue. So it's starting to catch up with itself, the appreciation. There's certainly some markets still that haven't quite caught up with that appreciation in the actual recorded sales that we need to use as the market value comps. The only thing that I would mention, though, that we are kind of finding as a hit and miss, you're probably aware of this too, Keith, is that short-term rentals, the more vacation rentals, and that type of income as it relates to an investment property appraisal. Because remember, an investment property appraisal comes with additional forms, one of which is called a 1007. This is simply the number on the page of the form. It's rental income comps. We get to give you a portion of the rental income to offset the new mortgage payment. As such, if it's a short-term rental, there are appraisers that have not really caught up to this and providing true short-term rental income. What they're going to do is they're going to be providing the long-term rents for such a property. And that may be enough, but if you're purchasing a higher-end property, I have a scenario right now. Let's use it as a case file. It's $1 million property in Missouri, actually. We're having a more difficult time finding an appraiser that understands the short-term rental income that we need to use to offset this much larger mortgage. So as far as appraisals go, I would say that if there's anything I'm observing right now, it's that the appraisers are taking a little bit longer to catch up with including the short-term income comps within the appraisal.
I'm selling a property right now, and I've had to wait longer for an appraisal report to come in than I've ever had to in my entire life. So earlier here in the discussion, you had talked about those terms required for a conventional loan, but there's an alternative way, a DSCR, a debt service coverage ratio program that you can tell us more about, which is interesting because I sort of think as debt service coverage ratio is that sort of qualification criteria that comes from the 5+ unit apartment world. But now you're applying it here to the 1 to 4 unit income property world. So tell us about that DSCR.
This product they're coming in hot. We're getting such huge demand for this loan. And I think that it's a combination of things. One, either the individual just can't fit into the conventional loan box, or two, they've maxed out their 10 golden tickets or whatever it may be. Or maybe it's that they simply are not wanting to go through the extra, I was going to call it brain damage, but I've already said it. So the extra vials of blood and DNA that comes in with
Right.
qualifying for a conventional mortgage, right? Anybody that's gotten a conventional mortgage is resonating with that statement. The debt service coverage ratio is all about the property. It's probably the easiest loan an investor is ever going to get. It's still a 30-year fixed product. We're going to take the gross rents, again, from the appraisal, and we're going to divide them by the proposed PITI. If that division yields a 1.0 to 1.49, the property qualifies for this loan. The truth is that the product can actually go to a 0.75 debt service ratio, but the interest rate really goes up from there. So the baseline is 1.0 to 1.49. Gross rents from the median on the appraisal divided by the PITI. 30-year fixed mortgage, 80% loan to value, no income documentation whatsoever.
Wow.
You're simply going to need an ID, insurance, and some assets that show where your down payment or your reserves might be coming from. The seasoning of those assets is only 10 days. Conversely, looking at a 60-day seasoning on a conventional loan. The product will go as low as 600 credit score. Actually, 70% would be the max loan to value on that guy. But from 600 to 740 credit score, you can expect varying interest rates and loan to value maximums. It's been pretty popular.
Okay, so it sounds like the DSCR, they still do look at the borrower, for example, their credit score a little bit. However, it's primarily based on the rent income that the property provides. So the DSCR, in short, is prioritizing qualification of the property's performance over the borrower's performance.
Correct.
I would imagine that perhaps some estoppel certificates would be required with the DSCR since it's being qualified primarily on the rent income that the property produces.
I'm not sure, Keith. I'd have to go back and look at the fine print within the guidelines. I have not heard that come up yet. We launched this mid last year. That doesn't sound familiar. That has not come across my desk as an issue with any of these yet.
Okay, but this DSCR program, this has been a good alternative for people that cannot get into that conventional box that we described earlier, or for people perhaps that want to get more than 10 loans.
Right. Or that, just don't really want, they're okay taking the higher interest rate because they just don't have the patience for what goes into a conventional loan and what's required.
Well, Jay, this has been a great, well-rounded conversation about what's going on with the mortgage lending environment today, what it takes to qualify for a loan. Are there perhaps any last things that people should know with qualifying for a mortgage loan for income property? Maybe something I did not think about asking you?
We're finding ourselves here. We're getting close to tax time. So if you need some strategy or some advice from your lender about how we want that schedule specifically to look, feel free to check in with us. We can start the strategy and the planning, taking a look at draft tax returns for you to make sure you're optimizing that piece. Because as most of you have heard me say, of all the different criteria to qualify, the debt to income ratio, especially for an investor, can get away from you before you even realize it. So that's a real value add I think that Ridge provides for its clients, is the strategy and structure specific to looking at Schedule E's and income and things like that. So be sure to let us know how we can help. Call us, email us, check out our website, ridgelendinggroup.com. Toll free 855-74-RIDGE is an easy way to remember, or email is info@ridgelendinggroup.com.
You keep growing. You now offer loans in 46 states. So the best way for you to get started with an income property loan yourself is at ridgelendinggroup.com. Caeli Ridge, it's been valuable as always. Thanks so much for coming on to the show.
Thank you, Keith.
Yeah, great relevant material from Caeli as always. In a high inflation environment, a mortgage is more valuable to you. If inflation is, say, 7.5%, like the CPI has been lately, and your mortgage is only 5%, well, you're benefiting 2.5% from that arrangement. And that's even if you had to pay back the debt yourself, like you would on your primary residence. But of course, with a rental property where the tenant pays both the principal and the interest for you, you are benefiting even more. Now, I really doubt that we're going to have this inversion type of setup that we have now, where inflation is going to be higher than interest rates for very long, because in theory, the bank is losing their prosperity to you. They're transferring that wealth to you, the borrower, when your loan is at less than the rate of inflation. And that's what does make today an exceptional time in an unusual time. But if you're a newer investor, it is important for you to understand that what you generally want to do is get your pre-approval letter from your lender of choice before you go shopping for property. That way, you'll know what you qualify for, and that's also going to give your property provider, that seller, more confidence that they are dealing with a buyer that's already approved for a loan before they take their time with you here in today's competitive market. You can get started with Ridge, if they're a good fit for you, at ridgelendinggroup.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.